So a lot of times when we hear about deliveries, we're thinking that physical silver is changing hands from one owner to the next. That's what we think a delivery means. But on the Comex, it's not that at all. A warehouse receipt, a warrant for silver, changes hands typically the day after assignment occurs, so very, very quickly, and that physical silver just sits there in the same vault. It could be the case that later on, that's the next warrant for the same silver changes hands to somebody else, and the warrant passes back and forth over and over. Meanwhile, the physical silver is sitting there the whole time. So we could see a very high number of deliveries, but all the physical silver just stays right there. In case you haven't heard some of these rumors going around, this is an example of what I'm talking about. This tweet here, breaking: Comex silver stress test, 21 days to go. March 2026 is shaping up as a breaking point. Demand, over 400 million ounces of open interest. By the way, that's true. Supply, only 100 approximately million ounces of registered inventory is falling. Also true. So you can see demand far exceeds supply by a factor of 4, and it doesn't sound good on the surface. February delivery rate hit 98%. We'll look into that. January deliveries surged to 49 million ounces, which are 7 times higher than they were 2 years ago. Also true. Inventory is draining at 780,000 ounces per day. Even at 25% delivery, Comex needs over 100 million ounces more than the current stock. And where are they going to get 100 million ounces from? At 50 to 70% delivery, demand would jump to 200 or 300 million ounces against 85 to 100 million ounces available. This isn't speculation, this is a math problem. The question isn't if stress shows up, it's whether Comex can make delivery. And he's got some notices here that support some of those numbers. However, he doesn't have anything here that supports the logic. Okay, so to see where this came from, I did some digging, and it actually came from a video by Clive Thompson, who I think is pretty respected. And that video is this one here. Comex silver, 21 days until over 400 million ounces of demand meets 100 million of supply. Now, a lot of what he says in this video is true. It is all based on real data, and he presents it on screen. So definitely good job. However, there's a couple interpretations of that data, as well as a logical leap, that don't add up. And when we piece it all together, it sort of undermines the entire cause for concern. Let me show you what I mean. So he starts with 429 million ounces of open interest for March as of February 4th when he recorded this video. He recorded it a few days ago, but he was using data from a day or two before, so fine. And 102 million ounces of registered silver. And then if you add in the eligible silver, so if you just imagine that all the possible silver that's eligible for delivery converts to registered and then is able to be delivered, that would still only total 390 million ounces, which is short of the 429 million ounces of open interest. So if everybody who has an open contract says, I want to stand for delivery, there wouldn't be enough, even under the most generous scenario. That's pretty scary, and that certainly makes it sound like the Comex could default. However, if we take this apart piece by piece, we realize it's nowhere near as dire as it sounds. So first of all, is it likely that all of these contracts stand for delivery? He basically says, well, in February, 98% of contracts stood for delivery, and so if March is similar to February, there's a problem. Okay, we're going to investigate that 98% number. And then if the 2 months are similar, if February and March are similar, then there's a problem, but we're going to look at that, and we're going to see that February and March are not similar months fundamentally. And then, of course, default is guaranteed. There's a little bit that goes into that we will look at.
The central claim rests on a comparison between open interest and registered silver stocks. However, open interest is often misunderstood. It represents the total number of active futures contracts, not immediate delivery requests. Most futures contracts are closed, rolled forward, or settled financially before delivery ever becomes relevant. Registered inventory refers only to metal designated as deliverable, while eligible inventory may also be converted if needed. Comparing total open interest to static registered supply assumes every contract holder demands physical silver simultaneously, a scenario that has historically never occurred in modern futures markets.
So, did 98% of February open interest really stand for delivery? Well, that should be pretty easy to figure out, right? Like, just take the number of February deliveries, divide it by the February open interest, and then you get the percentage that stood for delivery. It should be very easy, right? And the numbers he used, he said, about 18 million deliveries out of 19 million total open interest, and that was 98%. And okay, that sounds like it's plausible, except while looking at his numbers, I noticed that there was a remaining February open interest of about 4 million. So as of the particular day that he made the video. And I thought, well, wait a minute, if there's still 4 million contracts open, right, some of which could stand for delivery, I thought, well, wait a minute, if they all stand for delivery, then we're going to end up with 18 million plus 4, something like 22 million. 22 million out of 19, that's over 100%. And so my alarm bells immediately went off, and I thought, well, you can't have over 100% of contracts standing for delivery. That's not possible. So I knew something was wrong. So I dug into it, and then I realized that February open interest isn't just one single number, okay? So you can take the open interest on any given day, but even then, you can't just add it all up or take the largest one. What we have to do is measure the total delivery eligible open interest, okay? And to understand this, we shouldn't be thinking of open interest as a stockpile. We should be thinking of it as a flow. So let's use a bathtub as an analogy. Suppose we have a bathtub and it's some amount full of water. Well, that's like our open interest, and we could take a snapshot of that every single day if we wanted.
Another widely cited figure is an alleged 98% delivery rate in a recent month. At first glance, that suggests nearly every contract demanded physical metal, but the calculation often relies on a flawed denominator. Open interest fluctuates daily, flowing in and out like water in a reservoir. Measuring deliveries against a single-day snapshot ignores contracts that were opened, rolled, or closed throughout the month. Delivery-eligible interest must be viewed across the entire contract cycle. When evaluated properly, delivery rates are meaningful, but far less dramatic than viral interpretations suggest.
However, there's water flowing into the tub and there's water draining out. So the water flowing in, that's new interest. And the water flowing out, it could be deliveries, or it could be rolling into another month, like rolling into a different tub, or it could be something else. But for now, we're just going to simplify it as deliveries. So you could imagine that if we take a snapshot of the tub and the water is filled up a certain way, we could open the drain and the faucet the same amount, and water will flow in and flow out. So the tub level doesn't go up or down, it's the same the whole time, but water is still flowing into and out of the tub. And if we had that open for years and years and years, we would have a massive amount of water that flows out of the tub. But if we only did that for just a split second, we would only have a single drop that comes out. And if we wanted to know what percentage of the water was drained, it would be a fallacy to just look at the amount that came out and divide it by the amount that's in the tub. That doesn't make any sense, but that's what this calculation was. So it was basically a denominator error. So basically he took the open interest at some point in time, a snapshot on one day, just how full is the tub, and he divided the total amount of deliveries by that amount. But what we have to do is actually look at the delivery eligible open interest, which is everything that passes through the tub after the drain opens. So all of it that's in the tub and all of it that came through the faucet. You got to add it all up throughout the whole period you're talking about. It's not just the water level you see on one day. So if we were to do that, and by the way, the numbers are not publicly available from Comex, we would have to piece them together and do a bunch of investigative work and math. It would be a lot of effort. And how valuable would that number be? Probably not that valuable, so it's not really worth it. But what we would find is that it's definitely a smaller percentage than 98% that stood for delivery. It could be significantly lower, it could be a little bit lower, but it's nowhere near 98.
Not all contract months behave the same. In silver futures, certain months such as March, May, July, and December are considered major delivery months with significantly higher participation. Others, like February, attract a narrower group of traders, often with stronger delivery intent. Comparing delivery behavior between a minor month and a major month can lead to misleading conclusions. Historically, major months show lower delivery percentages because many participants are speculative or hedging, not seeking physical metal. Context matters. Market structure, not just raw numbers, determines stress levels.
And even if 98% was a realistic number, which it's not, we still have the question of, is February like March? And the answer is no. And the reason is pretty straightforward. February is considered a minor month. March is a major month. So this has to do with how many contracts are traded and what type of investors are participating. And in March, it's a major month. It's historically the most popular month out of the 12. February, nowhere near that. And anyone holding a contract in February after first notice day is really wanting delivery, the majority of them, more than half. And so February we can think of as a destination month. If you're still holding a contract after first notice day, you probably want delivery. Whereas in March, delivery is just an option for you. It's not the destination, it's not the reason you're there, and you may still choose to exit your position in one of many other different ways. And so in March, we get a whole lot of different participants, banks, hedge funds, everybody. And in February, those who stick around are heavily commercial, so delivery is the goal for them. As a result of all that, February tends to have a very high delivery percentage relative to the residual open interest, relative to the people that stick around. March, on the other hand, has a lower delivery percentage despite a larger participation rate. So February and March are not comparable. Whatever the delivery rate was in February, we should not assume that it's going to carry over to March. Definitely not. And finally, there's one other piece of his analysis that I want to talk about. It's not exactly a flaw in his analysis, and I'm not sure it's something that he overlooked, but it's something that comes up frequently with retail investors, so I want to explain it here. And there's a question about deliveries. Does a delivery mean that silver actually moves? And this is just a mechanism of how the Comex works. So a delivery on the Comex is a transfer of ownership of a warehouse receipt. Physical silver stays in the vault unless and until the new owner chooses to withdraw it. So a lot of times when we hear about deliveries, we're thinking that physical silver is changing hands from one owner to the next. That's what we think a delivery means. But on the Comex, it's not that at all. A warehouse receipt, a warrant for silver, changes hands typically the day after assignment occurs, so very, very quickly, and that physical silver just sits there in the same vault. It could be the case that later on, that's the next warrant for the same silver changes hands to somebody else, and the warrant passes back and forth over and over. Meanwhile, the physical silver is sitting there the whole time. So we could see a very high number of deliveries, but all the physical silver just stays right there. It doesn't leave the Comex vault. So just because you hear a lot of deliveries are happening, that doesn't mean that the silver is disappearing. Keep that in mind.
A critical clarification. A Comex delivery does not necessarily mean trucks are hauling silver out of vaults. In most cases, delivery is the electronic transfer of a warehouse receipt, a warrant representing ownership of metal already stored in an approved vault. The silver often remains physically untouched. The receipt can change hands multiple times while the bars never move. Therefore, high delivery volumes do not automatically equal inventory depletion. Only when metal is physically withdrawn does vault stock decline. That distinction dramatically changes the interpretation of headline figures.
Putting this all together, how likely is a March Comex default? Well, in my opinion, approximately 0.001%. So maybe 1 in 10,000. And this is where you say, so you're telling me there's a chance? Yeah, okay, there's always a chance, but honestly, we shouldn't want the Comex to break, okay? If the Comex breaks, people think, okay, that means the price of silver goes to infinity, maybe the price of gold as well. You're not going to get infinitely many dollars for your metals. So if the Comex breaks, you're going to have a really hard time selling to anybody because no one's going to know what the price is. And when trading comes back online in any form, there's going to be rules around it. There's going to be regulations, there's going to be reporting, there may be windfall profits tax, you may get an executive order 6102 repurposed for the modern era. Maybe it's gold, maybe it's silver, maybe it's both. It's not a situation you want. It's not a situation you want. You're going to have your metals confiscated, there's going to be a big problem, or nationalized, I should say. don't root for that. You don't want it to break. What we want to happen is it gets repriced fairly, it's well on its way, and we sell, and the market mechanisms work perfectly, and we go about living our lives. That's what we should be rooting for.
Technically, any exchange faces risk under extreme conditions, but the probability of a near-term Comex silver default remains extraordinarily low. Exchanges can raise margin requirements, incentivize cash settlement, adjust delivery rules, or encourage inventory conversions long before a systemic failure occurs. More importantly, a breakdown would not produce instant riches for metal holders. Trading halts, regulatory intervention, potential windfall taxes, capital controls could follow. A stable repricing driven by genuine supply-demand fundamentals would be far healthier. For investors, the goal isn't collapse, it's orderly price discovery.